Hello, traders. Gary Wagner here. Good morning. It is Wednesday, second day of February 2022, and this is the daily report for gold and silver. We do have moderate gains in gold and silver today. Inflation rate is still high, but most importantly, ADP came out with their private sector jobs report. Expectation was that they were going to add 200,000 jobs. Last month in January, the actual numbers came in of a decline by 300,000. It's quite a shocker, and it will be interesting to see what happens when the Labor Department releases the non-farm payroll jobs report on Friday. Trading in New York resulted in moderate gains for gold, currently up $5.80, a rise of 0.32%, with the most active April contract fixed at $1,807.30. Unquestionably, the dollar has acted either as a hero or a villain in regards to gold pricing. Over the last 3 days, we have seen dollar weakness, and the percentage drawdown in the dollar was roughly very close to the percentage gain in gold. Today, for example, you can see the dollar index is at 95.985, a decline of 0.40%. Gold increased by 0.32%. Putting up the Kitco Gold Index will give you a better indication, and I've just done that. Spot gold is at 1806.40. The gain today, $5.60, with 40 cents of that gain attributable to buyers bidding the precious yellow metal higher, but $5.20 was directly a result of dollar weakness. Silver had fractional gains today, only a 6 cents rise, taking the March contract to $22.65.5. But what we are seeing is it is certainly not reacting in the same bullish manner that we see gold reacting to. If you consider these last 4 trading days, if we look at gold, all 3 contain moderate rises in price. Today's opening letter focused upon the recent decline in the dollar and how closely it related to the advances in gold. While dollar weakness or strength is always a component to gold price changes on a daily basis, it is unusual to see dollar weakness account for anywhere between 90 and 100% of the price change in gold. As you can see, the decline on Monday was 0.63. On Tuesday, yesterday, 0.29, and today, 0.39%. Now, when we pull up a gold chart with the percentage advances, what we can see is that, first of all, today, gold gained 0.32%, and the dollar lost 0.39%, very close. Yesterday, the gain in gold was 0.27%, and the dollar fell by 0.29%. And then on Monday, we saw a net gain in gold of 0.62% and a decline in the dollar of 0.63. Almost exact on a couple of days and very close on today's action. Currently, we have gold at 1808. It has begun to trade overseas, and that is where it is currently fixed. Which brings us to our current strategy, and that is we are trying to have the most favorable price to enter gold from the long side before the jobs report is released on Friday. The rationale behind it is twofold. First, fundamental and also technical. On a fundamental basis, as I speak about in our opening letter, it was anticipated when the ADP jobs report was released today, it would indicate an additional 200,000 jobs being added to private sector payrolls, and the actual number that came in was a decline of just over 300,000. That is a huge differential between the estimate and the actual number, and more startling is the fact that the last time we had negative job growth was in December of 2020. Now, Friday's release of the Labor Department's jobs report is different than ADP in that it includes government jobs, because the vast majority of the jobs that we know were lost were actually in the hospitality sector. That accounted for half of the decline of 300,000. We can expect that the numbers that are going to come in on Friday might not be as healthy as the tepid numbers that are currently being predicted. The estimates for Friday's report is an additional 150,000 jobs being added. That's a very low number, but it could in fact come in negative, just as today's ADP report comes in. If that's the case, that would be a bullish undertone for gold. That is the first rationale. The second one is a strictly technical reason, and that is the identification not only of a compression triangle, but the distinct possibility that we could be at the last leg of it, in which we would see this fifth wave not only trade higher with one decline, but break above, and that's the important component, the long-standing resistance line that was created from a series of lower highs. Back in June is the first one, October is the second one, and then this last one at the beginning of 2022. You notice that they are all key and critical tops in the market. It is for that reason that I do want to position ourselves from the long side. I am just hoping we can get a proper dip so that we can get in at a reasonable price. We are raising our target entry price to try to get in around $1,800. I am monitoring the market closely during the daylight and evening hours here in the United States. And then in Europe, we have a team that will be watching for any price changes or dips during that time period. We have all of today as well as tomorrow before the report is released to initiate a long gold trade. This has been Gary Wagner wishing you, as always, good trading. We will talk to you tomorrow for the next daily update and review. Bye-bye.